As gold hits record levels again, investors are rotating into safer havens. We know that because the gold run up last year and this year continues. Let's go to Christopher Kerlow. He's Senior Portfolio Manager and Investment Advisor with Canaccord Genuity. Thanks for coming in.
Thanks for having me.
What a run it's had, now over $5,000 an ounce. Do you think it'll carry on this year, this run?
Honestly, we've been pretty heavily invested in the precious metals trade for over a year and a half now. If anything, we're lightening up a little bit, looking for a pullback. You could see, gold at 5,000, silver over 110, I think, today. They can give up some of those latest gains pretty quickly, at which point we'd be adding back to our positions.
Interesting. Okay, what about silver, which has also had an incredible run?
Yeah, critical metal. We're an owner of Microsoft. They're building a data center in Texas right now that's going to require about 5,000 tons of silver. They want to do about 15 of those. For the last 3-4 years, we've been running at 5,000 tons of silver deficits globally. And so you see this mismatch in supply and demand. And, we need it for everything for the data centers, which are becoming not just creating cool images on ChatGPT, but also a critical component of technology, defense, and sovereignty.
Okay, you mentioned you'd wait for a pullback in gold before putting new money in. What kind of pullback would you look at?
I think we like the miners at this point. There's still a few. We own Agnico Eagle, Alamos, both key positions in the LWC portfolios. We'd probably just be adding back to those, which we've been trimming, programmatically here for the last probably 6 or 8 months. We've had to take profits 2 or 3 times on both those names.
There are some who think silver's going to correct wildly, like it's really going to come off. Would you put some money in where it's at today? Would you also wait for a correction? If so, what would that look like?
Yeah, we've been adding to silver names. I was looking at a silver deal this morning, doing some site visits not long ago. And so I think that there's a lot of underappreciated assets out there. And it's not so much even the mines, the challenge that we've been hearing with Donald Trump, it's also that smelting, that midstream refinery. I think that I'm excited to see where we can build some of that capacity here in both North, South America, where we can control a little bit of the flow of that silver to North America.
Okay, let's talk about the energy file, because I know you like a few names there. And I'm wondering if the names you like are based on sort of the AI build out or infrastructure built in Canada, or where they're coming to you from. Pembina is one of them.
Yeah, so Pembina is a recent addition for us, 6% dividend, fully supported by free cash flow, very low debt profile, more east-west piping. They have a modular system, tend to be close to the asset base. We funded that trade with some profits from TC Energy and Enbridge, which obviously have some huge north-south component to it. With what happened in Venezuela, we thought we'd diversify our geopolitical risk a little bit with that trade, but net overall adding to energy, which is one of the few sectors we saw value coming into 2026.
Okay, so you mentioned Enbridge along those lines. AltaGas is another you're looking at?
Yeah, again, it's just leaning into this energy theme. After our Canadian dividend portfolio being up 26% last year, pretty hard to find value out there, and low risk. It's more of a utility stock, but has energy beta to it. You can see the chart here; it's come off a little bit, so we thought we'd add at the start of the year, with the TSX up almost 4% already so far in January.
Okay, so we talked precious metals, we talked miners along the same lines, we talked energy. Where else are you looking to diversify?
We use liquid alternatives now. We're not huge fans on the bond trade. I think if we saw the 10-year yield creep back above 4.5 or you're closer to 5, we could be adding some diversification through bonds there. We've seen this rolling correlation between bonds and equities over the last 2 years, so you're not really getting it. So we own things that are merger arbitrage strategies or credit strategies that are just plain idiosyncratic credit events, not so much like long duration, like a traditional fixed income manager. And I think it's crucial to add that to things like the precious metals trade. We see that as a diversifier. Gold's obviously broken away from a beta standpoint, even a little bit of crypto, Bitcoin exposure across the board in our client portfolios.
Let me ask you if you're staying away from sectors that you think could be affected by tariffs. We have Donald Trump now threatening a new 100% tariff on Canadian imports. We know the language changes constantly, but CUSMA is up for renegotiation. So are you trying to stay away from sectors that could get hit by this?
As we've seen over the last year, it's been a lot of rhetoric. Canada and both Mexico have actually been the biggest winners in this trade war, with about a 5% tariff net over the last 12 months. Much obviously China's been on the other end of that spectrum, and then everyone else in between. So we've been, doing pretty well with it. Obviously, reliant trade partners, so we don't pay much attention to it. We were actually big buyers during April around Liberation Day. A lot of stuff came on sale, and so we have a short list of names that we're looking for. If we had weakness related to trade talk, we would make those adjustments. And I think the Pembina trade that you talked about, it's also a bit of that. Let's stay focused more on trade of oil inside our own country versus being reliant of getting our heavy crude down to the United States.
Okay, I'm going to leave it there. Christopher, thanks for coming in. Good to see you. Christopher Kerlow, Senior Portfolio Manager, Investment Advisor at CG Wealth Management.